Hello, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it's my pleasure to present our third quarter economic review. At our firm, as always, we partner with clients and believe an educated client is our best client. While we always try our best to help you with your finances, we believe that knowledge is power, and one of our missions is to share my knowledge with clients to help them make more informed decisions. As you can see from the charts, while the third quarter ended with a strong result, the 3-month period was not a smooth ride by any means. Volatility remained prevalent for investors. August was the S&P 500's most volatile month in nearly 2 years after several factors, including weaker than expected jobs data from July, thus increasing recession concerns. However, equities regained most of their losses by the end of the month, and after taking another dip in early September, were once again in record-breaking territory by the end of the quarter. For the three-month period, the S&P 500 rose 5.5% and closed the quarter at an all-time high of 5,762. This brought the S&P 500 year-to-date gain to nearly 21%. The Dow Jones Industrial Average also had a record performance, rising 8.2% for the quarter, ending at 42,330. This brought the DJIA's year-to-date gain to over 12%. For long-term investors, the first 3 quarters of 2024 have been recorded as the best first 3 quarters of any year in the 21st century. In August, the year-over-year consumer price index was 2.5%. This is the lowest annual increase since February 2021, suggesting that the Fed's coveted 2% inflation rate be met in the near future. The core CPI, which is CPI, remembers excluding food and energy, was 3.2% year over year, which was slightly more than expected due to the increased shelter and transportation services prices. So the much-awaited first interest rate cut since the onset of the pandemic happened in the third quarter. On September 18th, the Fed lowered the federal funds rate by 50 basis points down to 4.75 to 5%. This ended a 23-year high for interest rates. The stock market responded very favorably to this rate cut. The Dow Jones Industrial Average reached a new record as it closed 1.3% higher upon this announcement and topped 42,000 for the first time. The S&P 500 rose 1.7%, which also setting a new record, closing at over 5,700. Starting the year, it was anticipated that we could see 3 rate cuts in 2024. As of the third quarter, we've only seen 1 rate cut. There are 2 more scheduled FOMC meetings in 2024, and in the Fed's September economic forecast, it was suggested that additional rate cuts could be coming for this year. Interest rates and inflation are integral to investors' financial planning, so we will continue to monitor any movements and stay apprised of key economic indicators. U.S. Treasury yields have shown a downward trend, though in the last few days they've actually started trending back up. The inverted yield curve ended in September after a record-breaking of 793 days. As of September 30th, 5-year Treasury notes yielded 3.58%, 10-year notes yielded 3.81%, 20-year notes yielded 4.9%, and 30-year notes reached 4.4%. Though again, in the last week, we're seeing these numbers climb here in October a bit. Shorter-term yields, such as the 2-year note, have also declined, signaling changing expectations regarding interest rates. We will continue to monitor closely how the Fed's movements and interest rates are affecting bond yields. With the Fed's anticipating lower interest rates this year, the opportunity to get lower risk, high-yielding bonds may now narrow. But safety comes with a cost. Many major banks still are offering low rates to savers. According to Barron's, the average bank money market rate on September 30th, 2024 was only 0.51%, and the average 12-month CD rate was 1.95%. We've seen our CD rates, the broker CD rates, have dropped down too. We were getting over 5, now we're getting just a little over 4. They have decreased in the last 12 months, and many savers are seeing even lower returns. So if you're interested in exploring better rates, please contact us. We can get better rates at the banks. It's still going, that's still happening. And then although there is still a lot of uncertainty in the world and the economy, we are still currently experiencing a bull market. This bull market began in June 2023 after the S&P 500 rose 20% from its low in October 2022. Many investors are speculating about how long this bull market can last. While previous performance is not an indicator of future results, historically, the median bull market lasts about 46 months or 3.8 years. As of September, This current bull run is only 21 months old. While many analysts remain optimistic that we will continue to experience this record-breaking rally, several volatility-inducing events are waiting in the wings, including the U.S. elections and continued geopolitical risk. Volatility will continue to be a concern moving into the coming months. A few of you have asked me, is the market going to crash? A few of you are sending me some of these crazy news reports. Be careful what you're reading out there. When somebody says the market may go down 50%, think about that line for a minute. Anybody could say that. And so right now, the markets, there's a lot of money sitting over the sidelines in these money markets and CDs, over $6 trillion. With the rates coming down, that's why money started moving back in. If the rates continue to move down, we'll continue to see that money move back in. Historically, elections 3 months prior tends to be volatile. I've told many of you that. I've told it here on these broadcasts. And we're seeing that to a T. Election years tend to end strong. I think just having this election over with will be positive. There's problems as we go down the road into next year, and it's going to depend on the Congress, not on the presidency. What's the Congress going to do? What are the policies? That's what we need to focus on. We don't even know who the new Congress is. So be careful here on elections and fear mongering, because that's all it is, people trying to be heroes. So the global economy experienced continued uncertainty during the third quarter. Global tension persisted, including the heightening of conflicts in the Middle East and the ongoing Russia-Ukraine war. As you know, we are currently also experiencing a presidential election that is highly contentious, as I was just saying. And remember that the statistics show that typically, and especially over long periods of time, economic and inflation trends affect equity markets more than election results. Because this is an unusually racist election, we cannot overlook the potential of a short-term election aftershock in the stock market. Market may very well go down. It may go up. We don't know. And trying to time it will hurt us more. So regardless of who is elected, both candidates propose changes in tax rules and economic policy, and they're both leaving much uncertainty. While earnings in the economy are the main drivers of financial markets, we are committed to keeping you apprised of any changes we feel could affect your personal situation. As we move through the rest of this year, remember we have Dr. Quincy Crosby coming in 1 week after the election. Those of you who are nervous and worried, this is going to be a good meeting. Be watching that those invites should have hit your mailboxes already. Currently, the U.S. economy continues to show signs of strength and resilience. The hope of a soft landing comes to fruition as growing and talk of recession is subsiding. While it still could be a concern, it's looking hopeful the Fed has deflected at least a hard recession. This is a good time to remind you of a quote from Yogi Berra, where he said, "It's tough to make predictions, especially about the future." Now, as always, is the time to stay focused on your personal objectives. One of our main goals is to help our clients create a solid financial strategy that considers their risk tolerance, time horizon, and potential tax implications. We believe in proactive preparation and providing clients with a resilient financial strategy. It's important to consider equity investments from a long-term perspective. This is a good time to take a look at your investments to confirm they still align with your goals. We've been doing that with all of you all year long. I've been saying before, we think this market will end strong, but there can always be a geopolitical event. We just can't predict those. Make smart investment decisions and monitor your expenses. Really important to be getting out of debt now. I've been saying that all year. Raising your cash levels. At some point, we will have that next recession. Who knows where it is down there? We're overdue for it. And we will continue to be reviewing your investment strategy, and we're happy to do that with you. So here's a recap, some things to remember. Equity markets closed out the third quarter with very solid results. The federal funds rate was reduced by 50 points to 4.75 to 5. The Fed is anticipating possibly more rate cuts this year. Still think we might get them. It just depends on the economic data here in the next few weeks. Both the economy and the equity markets ended the quarter strong. Volatility remains. Remember, one of the goals of having a well-balanced portfolio is designed with the understanding that volatility is always possible. This is important to remember what your risk level is, what your tolerance for risk is, where you're at and why. Those people in retirement or just coming into retirement, I have you just behind those index numbers. I don't want you in the indexes. I don't want you beating indexes because we don't know when this is going to change. And I don't want you going down harder than the indexes. Those people that are younger, we're beating the indexes by 3 to 4 percentage points across the board. So we can beat indexes, but we also want people to sleep at night. And I don't think younger people have more time to make up on being more aggressive like that. Be well prepared. Recent history has shown us that anything can happen. So once again, caution should still be the principal notion for investors. And that is what we have been doing the last year. Very much moving forward with caution, taking profits, rebalancing. We're going to continue to do that in the next year. We're going to continue to watch very closely who the new Congress is, what they're going to be doing next year with these tax cuts going away if they don't do something. And I think the deficits, we need to be watching that very closely. At some point, those will become a problem. As always, we are grateful for you and value the opportunity to accompany you on your financial journey. Our goal is to assist more people just like you. The greatest compliment you can receive is a referral. Many of our most satisfied clients were introduced to us by existing clients. If you know of someone who could benefit from our services, please consider sharing the video or adding a friend to our mailing list. We would be honored if you could provide us with their contact information so that we can add them to our distribution list, which enables them to receive our newsletters, and we invite them to watch these presentations and to attend our live presentations. If you know people that are concerned as we move forward, again, the November workshop we've got coming with Dr. Quincy Crosby, it doesn't get any better than that. She's going to give us an update on everything as they see it, which will be 1 week after the election as we move into the next year. This is where bring people that are concerned. Bring your friends, your family. This is the one to do it at. Once again, thank you for your trust in us. One of our main objectives is to keep you informed, and we appreciate you taking the time to watch this update. Please feel free to give us a call if you have any questions. Have a great rest of the week.